Welcome to Denver Startup Week. I'm Tammy Dorr, President and CEO of the Downtown Denver Partnership and co-chair of Denver Startup Week. This year marks the 10-year anniversary of Denver Startup Week. DSW has been the catalyst for lots of change over the past decade. And this week, we're coming together to celebrate the past and dream big for the future. We are able to bring Denver Startup Week to this community thanks to our 2021 sponsors. Thank you to our HQ and title sponsor, Amazon, and our title sponsors whose leadership makes this week come to life. Capital One Cafe, Downtown Denver Partnership, Fluid Truck, Hotel Engine, and WeWork. And our track sponsors who have made all of the great content you're hearing today possible, our founder track sponsor, Kickstart, growth track sponsor, Friday Health Plans, developer track sponsor, Quizlet, product track sponsor, Palantir, our designer track sponsor, Battery 621, and the Public Works, people track sponsor, Exactly, and spotlight event sponsor, Strat Labs. Our headline event sponsors are bringing the excitement to the week. Thank you to B-Side Fund, Colorado Public Radio, Comcast, Coors Brewing, Denver Pavilions, Entrepreneurship at the University of Denver, JP Morgan Chase, Method, Moss Adams, Pi Insurance, Promontory Mortgage, Path, Southwest, Tattered Cover, and VF Venture Foundry. Finally, thank you to our partner and member sponsors, all listed on the screen. Please say thank you to these companies as you enjoy our hybrid Denver Startup Week. And don't forget, use the hashtag #DenStartupWeek to share your experiences and moments of inspiration on social media. Have a great week.
Hello, everyone. Welcome to Denver Startup Week. I'm John, the Spotlight Track Chair and member of the Denver Startup Week Organizing Committee. Before we get started, the Denver Startup Week Organizing Committee acknowledges Indigenous people as the original owners of the land on which we reside, which is the traditional territory of the Ute, Cheyenne, and Arapaho peoples. We acknowledge the painful history of genocide, ethnic cleansing, stolen land, forced removal, forced occupation of their territory. And we honor those who have stewarded this land throughout generations and all other Indigenous tribes and nations who call Colorado home. Thank you for joining us for the 10th anniversary of Denver Startup Week. At Denver Startup Week, we strive to make all of our sessions a space where attendees can connect, learn, and grow, regardless of age, gender identity, gender expression, race, ability, sexual orientation, or the combination of those identities. There is something for everyone at DSW. Thanks to all of our community members who submitted their best content to make this week what it is. And thank you for joining us. Thank you to our sponsors for their support in helping us keep DSW free and accessible for all, especially our Spotlight Track sponsor, Strat Labs. With that, please enjoy this session and the entire week.
Good morning, everyone, and we're live at our Amazon headquarters for Denver Startup Week. My name is Virginia Chow, and I'll be your moderator today for investing in social impact. I'm also the co-founder of Capital Studio, which is a blended capital group to support underrepresented founders. Capital investing needs to be more than just financing an organization. Social impact is really about, one, how do you make a difference and solve challenges in our community, as well as how do you drive economic growth for underserved communities as well, and also fuel and finances our entrepreneurs. So I'm so excited today because we have two leaders in our industry to talk about social impact. We have our CEO, Ryan Kirkpatrick, and also of Colorado Impact Fund and the president of Friday Health Plans that was funded by Colorado Impact Fund as well, to talk about investing in our community, investing in growth, investing in impact, and how do we also make money at the same time. So a few housekeeping things today. We'll have a conversation for about 35 to 40 minutes, and we'll have about 20 minutes for questions live in the audience and also online. So let's begin. I have some softball questions for you first, guys. One, tell me a little bit about yourself, your company, your fund, and what does social impact investing mean for you?
Want to go first?
Sure. Thanks, Virginia. Great to be with everybody today. Always love to participate in Denver Startup Week. It's kind of one of my favorite weeks of the year. And it's great to see actually some human faces here. I feel like I've been staring at screens for months now. So the Colorado Impact Fund, I launched with my partner, Jim Kelly, about 7 years ago. And the mission of the fund was to take Colorado money. So we have 26 limited partners. They're all from here in Colorado. It's high net worth individuals and family foundations. And to invest that money into great impact and Colorado headquartered platforms. And so we launched in July of 14 with that mission. In terms of where we focus, we're an early stage venture fund. We're investing at the Series A, Series B stage. Typically, we're investing about $1.5 million to $5 million in each platform, and we're focused on companies in a lot of the common impact verticals: healthcare, education, climate. Also very focused on democratization of entrepreneurship, and that takes two forms. One, how do we support underserved populations of founders? And then second, how do we get some capital to work in places that aren't Denver and Boulder, which is where most of the institutional capital gets invested. Friday Health Plans happens to be one of the companies that we invested in that theme, with their headquarters in Alamosa, Colorado, which is super exciting for us to get some capital to work there and just see a lot of the economic development that's happening there that David can go into. But with that strategy, we've invested in 13 companies. We've raised $85 million across two funds, and we've got a lot of capital still to put to work out of our second fund. And really excited to be here today to talk more about our impact strategy and the broader landscape.
And I'll give a little background on Friday Health Plans. So we are a specialized, small, high-growth health insurance company based here in Colorado. We're focused on people who buy their own health insurance. So people who don't get a health benefit from their employers, typically people who are buying on one of the state or federal ACA exchanges are our customers. And the insight that led us to want to start this business was that, while big health insurers are good at many, many things, they're not good at consumer. They're really good at building health benefits for large corporations and for government agencies. But we knew that there was a blind spot around who are these health insurance consumers and what are they going to want to buy and how are they going to want to buy it. And we knew that if we could put together the right team of people and a little bit of capital, we could learn faster. We could get into this market, figure out who these ACA consumers are, what do they want to buy, and build a really interesting company that could have impact, both financial impact, healthcare impact, and to our surprise, even community impact. We actually started the business in rural Colorado. So we got the business off the ground by making an acquisition. We found a nonprofit HMO based in Alamosa. It had been around for 45 years and was about to go out of business, but for an infusion of capital. And we basically took our own money and a little bit of seed capital, and were able to basically acquire a nonprofit HMO to use as the platform for this idea that we had. And we used all of you guys, the people of Colorado, as our laboratory to start testing out different benefit designs, different provider network designs, different underwriting models, until we found something that really worked and was really different than anything else that was in the market. Our first expansion market was Denver. So we moved from rural Colorado into the Front Range in 2018 and 2019. In 2020, we started launching new states. So we went live late last year in New Mexico, where we're statewide, in Nevada, where we're statewide, and 7 major metros of Texas. We're about to go live in 3 more states. So when open enrollment starts in the middle of November, we'll be live in North Carolina, Georgia, and Oklahoma. We've done this, our seed A and B rounds was around 25, 30 million capital. We just completed a C round that it was about 100 million in equity, another 60 million in debt. The business is about break even. And so that capital really is to help fuel expansion into new states. We have to put surplus capital in every state that we go into, and we have a little bit of startup costs in each place. And so that's what we're using the new capital for. We've got about 90,000 members on the platform today, and that represents about 400 million in annual recurring revenue. So we're off to a nice start. We're in the fun part right now. We grew the business around 400% from last year to this year. We probably won't be able to grow quite that much next year, but we've got we're pretty ambitious, and we're laying down a lot of tracks and a lot of new markets to help us really sustain a high growth rate for the foreseeable future. In terms of social impact, it's funny, I don't think we had the word social or impact anywhere in our business plan when we were starting the company, but you can't be in healthcare without touching those things. And it was actually interesting when we met Ryan very early on in the evolution of the company. We were looking at some of their investment criteria and we're like, oh, we would never call ourselves a social impact company, but we meet those criteria and exceed a lot of them. Is that what we're actually doing? And we didn't even know it. Again, we got into rural Colorado a little bit opportunistically, a little bit by accident. And what we realized when we got there, this health plan we bought had done a few things wrong that we were able to fix and was doing a few things we could stop doing. But what was phenomenal about this company, we realized it right away, was they delivered a level of customer service that I had never seen in a health insurance company. And in my last venture, I'd probably been inside every health insurance company in the country. So I knew what I was looking for and I knew what I was looking at. I'm like, holy cow, what are they doing here that's so different? And we realized as a rural local health insurer, they treated everybody who called on the phone like they were a neighbor. Because guess what? They probably were, right? Or a relative. And our thought as entrepreneurs was, well, what if we could do that in more places? What if every time someone called on the phone, they got treated with a little bit of empathy and a little bit of care and like they might actually be a neighbor that you'd bump into at the grocery store? And so that's been really kind of the heart of our business plan is how do we apply that level of service and care and empathy in an industry where none of those things seem to really exist? And how do we scale it in a way that we can do it in the rest of Colorado and in lots of new states? And so that's the journey that we're on right now. And what became very obvious to us is when you work and live in a small community like Alamosa, everything we do as an employer there has an effect on that community. We are a part of that community, and we can't forget about the effects of what we do when we are building out that business, when we're hiring people. Fortunately for us, it's a community where there are a lot of people who are looking for jobs like this. And so it hasn't been that difficult for us to grow our employment base there. But there are also times where we realize, wow, if we hire everybody away from the hospital, that's not going to be a good outcome for the community over a long time. We still need people to work in that hospital to support our members and support our employees who live there. And so, we have to pay close attention as we're growing exponentially in this small place to what are some of the downstream effects, who are some of the people who might be negatively affected by that, and what can we do to mitigate some of those impacts so that we don't burn out this community through our own growth.
We got super excited in the early days of Friday, looking at this community of Alamosa. They had 70 employees when we invested. And what do you have now? Over
350.
350.
Yeah.
That's 280 new jobs in a community where I think the average salary is probably half of what you see in Metro Denver.
Yeah.
And the salaries that the average salaries these guys are paying are in the kind of 90th percentile of that community. So these are super attractive jobs that are really improving people's lives. And I think Sal and Dave have also done a really good job of connecting with, a lot of the institutions in the San Luis Valley education communities to create, pathways for people who leave school and can find a really good job in their own community, which is super exciting. So it's been an amazing, I think, workforce development story in a community that really, really needed it.
Yeah. And one of the things that we're curious about as a company is, at some point there's sort of a tipping point where, we've hired enough people in this place and anything else we do is going to be kind of destructive to other employers there. How do we find the next one? And can we do it a second time? How do we identify the characteristics of another small city, rural community that we could benefit from and would really benefit from us being there?
Well, actually, can you tell me about how are you balancing the bottom line? And what obstacles have you faced as an entrepreneur to grow and scale in another state, but still being mission aligned and also accountable to your investor as well?
Yeah. Here's the good news. And what we've generally found in healthcare, we're not often making those decisions where, doing the right thing conflicts with the bottom line. Healthcare in this country is kind of complex. It's a little bit messy and often not done very well. And so we're constantly finding opportunities to do things that on the surface might seem like they cost a lot of money, but actually over time save money and make people happier and healthier at the same time. I'll give you an example. One of our early discoveries when we started the business was people really don't want to pay more for health insurance. They'd rather pay less. How about that? But in a way that we hadn't even anticipated. We were sort of worried that as a new brand, people wouldn't be receptive. Turns out most people who are shopping for health insurance don't really care about the brand if they feel like they can save money. And that was really helpful to us. But what we also find out is a lot of people buy health insurance, they save a little bit of money, and then they realize, wait, I have a $9,000 deductible. That means I don't have any health insurance unless I'm hospitalized for 2 days this year. What are the odds of that? And it's not a great feeling. And a lot of people feel sort of duped or bait and switch. And so the challenge for the Friday team was to figure out, well, how do we mitigate that? How do we add healthcare services that are cost effective, that people are going to appreciate and they're going to use without raising our premiums? So one of the things we did that, again, looking back seems kind of obvious, said, well, let's just make primary care free and unlimited to people. Now, there's a cost to that, right? You take that to your local actuary and they'll say, all right, this is what it's going to cost you and it's going to require you to raise your premiums. We thought about, well, what happens when more people go to their primary care physician? Maybe fewer unnecessary visits to the emergency room. Those are incredibly expensive. Maybe fewer visits to urgent care. Those are moderately expensive. And maybe fewer visits to specialists, unnecessary visits to specialists. And so we found that by creating this unlimited free primary care benefit and combining it with a rich network of primary care physicians, it costs a little bit of money, but it's saving money down the line. It's helping us be, even as a small health insurer, extraordinarily price competitive in the market. And we've got lots of examples of things that, we're not burning a lot of not burning a lot of investor capital to do it. We might be spending on what may on the surface look like a little bit of money, but saving for our customers a lot of money down the line.
And Ryan, tell me more. Is it just number focused when you look at investments? Like, what are the tangible things people should be thinking about in terms of impact investment that makes sense to an investor?
Yeah, I mean, for us, and David touched on this, it's really about it's about no trade-offs between impact and scaling. And it's not necessarily an easy alignment to find, but as an impact investor, that's really what you're looking for in each of these business models. We spend a lot of time before we invest really understanding the mission of each of these companies and really what they're trying to accomplish from an impact perspective. And we really set very specific KPIs that are specific to their business. So these aren't the ESG metrics that everybody measures. These are metrics specific to that business model. And when we pick those KPIs that we're really going to measure at a board level and really push the team to continue to advance, we want those metrics, if they do succeed in improving those, to also create shareholder value. So it's really that alignment with impact and scaling that we're looking for. And David and the Friday Health Plan team's business is a great example of where you can find that alignment. So it's not always perfect, in this category, but I think in their case, there's exceptional alignment. And so the more people that Friday Health Plans is getting onto their low cost plan, the less uninsured that we're going to have in this country, the better healthcare we're going to have, we're going to lower healthcare costs. Those are all incredibly awesome impact missions, and that's essentially what their business is designed to do. So it's that alignment that we're really, always struggling to find.
Cool.
Yeah.
And when you're raising capital, I consider it like dating. It needs to be a mutual consent and as well. So tell me the story about how did you find each other? Like, how does that work for all the founders in the room? And how did you decide as an entrepreneur, he was a right fit and vice versa?
I think our first date was at our office, maybe. I don't know.
Yeah. And we were introduced by another local healthcare investor. I think
we were
Pete
set
Hudson
up,
might have introduced us.
Yeah,
So it was one of those.
Yeah, no, it was really interesting. Like when we first met David and Sal, they were going to buy this nonprofit health plan in rural Colorado and convert it to a for-profit. And I've been investing in the healthcare industry for a long time, and I thought this was a crazy idea. And I told Sal and Dave, you shouldn't do this. Way too risky. I think this plan is going to be really hard to turn around. This business is going to require a ton of capital. This is a very, very hard category. I would try to find another idea. And like all great entrepreneurs who have big ideas and want to transform industries, they didn't listen to me, and they had a lot of conviction around what they wanted to do, and they ended up raising some capital and buying that plan. And thankfully, they came back to me and said, "Hey, we actually did it." And I was super excited at that moment, and actually brought my old firm in to lead their kind of first really big institutional round. And I guess that part of the point is that, David, Sal, and I got to know each other over the course of many years. I got to see these guys in action. I got to see them execute on what they said they were going to do. And it's so much easier to write a check with other people's money into something when you really have confidence in somebody's ability to execute. And so, a lot of this is relationship building. It's not easy, at least for us, to meet somebody and 60 days later, have written a check in their business. Most of the deals we do, we've gotten to know the business over the course of many years.
Yeah, that's absolutely true. And what I would add to it is, we had a good enough story that, we felt like we could get in to any investor and get a date for a pitch. And we made a lot of pitches. And what we learned, and again, this is our own naivety, was that investors tend to have specialties, and they have sweet spots and comfort zones and things like that. And ultimately, the investors that we wanted to bring in were people who had invested in the health insurance space and had a good experience before. And that doesn't describe a whole lot of, growth equity, venture capital, or private equity investors. It's a pretty small universe. And so we got a lot of reps pitching ourselves, but we had a lot of unproductive reps too, where we talked with investors who were fascinated by what we're doing. They loved the disruption opportunity. They loved the size of the market. We get to the third or fourth meeting, and they would say, "Wait a minute. So if there's like a flu epidemic or something like that, you guys got to pay for it?" Like, yeah, we're a health insurance company, and that kept happening over and over again. It was clear that we weren't communicating that really important point early on. I think we were letting them believe we were a fintech company or software as a service or something like that, and we got better over time of saying we are a health insurance company, and we're going after a very specific population with a very specific business model. And the investor that Ryan introduced us to, Peloton. They had invested in 2 early stage health plans before with very, very good results. We got about 6 minutes into the pitch where they stopped the pitch and said, "Let me play it back to you. You're a health insurance company going after the consumer market. You've done this, you've acquired a plan, you're on the verge of turning it around, and you intend to do this." Like, yes. And we looked at each other and thought, well, finally, this is pitch 107, and we're finally talking with an institutional investor that's qualified to do this deal. That actually understands what we're going to do. And that wasn't the end of the conversation. It wasn't term sheet next day, sign the next one. It was still a multi-month process, but when you find it. And if I had advice for people who are getting a business off the ground, it's, you may be tempted to take every meeting you could get, and there's some value to that in terms of getting reps with your pitch. But find people who will recognize what you're doing, who will understand it, and be good investors for you. Because investors aren't just a check. It's not just money. I mean, these are people that you're going to be partners with, you're going to be working with. And, if you're going to have to educate someone every day on what your business really does after you've taken their money, it's not going to be that fun. And, we want to have some fun doing this.
So what I heard from you is, Dave, is that you want strategic investors that align with your mission and goal. And sometimes you'll get a lot of no until you get a yes. And that's okay, especially for all the founders in the room. Yeah. And when you're an entrepreneur, I think the one characteristic is you got to be okay with no as well. And one thing I want to ask you, Ryan, you talked about relationships are so important. How do people find you? Like, what if they didn't know you or know someone that like, is it only warm introductions? Like, how do people that are starting out or underrepresented in particular have access?
Yeah, this is something that we've hopefully improved on over the years. And it's super important to us because we view ourselves as at least hoping to be a community resource and a community asset. And one of the things that we implemented recently is we have office hours. You can go to our website and you can literally sign up for a meeting with one of our investment professionals and spend about an hour with us. And oftentimes these are businesses that maybe aren't really a fit for us from an investment perspective, but we really enjoy and love engaging with the entrepreneurial community and trying to give advice on how people can scale their business and improve their business. Those meetings sometimes lead to conversations about investing too. So we've tried to create a really low barrier access model. I mean, certainly referrals in from people that we know always are, I think, helpful, and add a little context for people. But I think generally it's pretty easy to get in front of us, hopefully.
Yeah, I would agree with that, by the way. I mean, we had a warm introduction, but you didn't know us.
Yep.
And, even though the answer was, this is not something I can invest in and you people might need help, you also left the door open. And we continue to check in and have conversations, and hopefully not in a way that was a pain in the neck to you, but more of the update of, hey, some of that stuff we said we were going to do, we've done it. And some other stuff we said we were going to do, we're about to do, and just kind of keeping you in the game.
Yep.
So Ryan, is it fair to say, even if they're not ripe enough or it makes sense to you right now, they might later on, so they should start early to curate that relationship? Or maybe you have referrals too.
Yeah, well, look, I think it gets back to what I said before, which is it's really hard to just meet somebody and then write a check 2 months later. So we prefer to meet companies before they're ready for our capital, so we can follow along. We can see how the story develops. We can hopefully prove, usually through advice or introductions to really good talent or customers, that we're a really good partner for the business. And so it's kind of like a two-way street, right? We're getting to kind of watch the entrepreneurs work and see if they can execute on their plan and how their model develops. And then I think for the entrepreneur, it's a time where we can demonstrate the value we can bring. And because at the end of the day, like we're making an investment decision, but that entrepreneur is making a decision too, to partner with us. And these things can be 10 to 12-year relationships. So I think that time that you get to spend with each other, get to know each other, and how and whether the partnership will work is super important. So we like to get to know businesses early.
Yeah, I can't say enough about what an influence the Impact Fund has had on us as a company, even before they were investors, helping us meet other investors, helping us mature the model, asking us hard questions. And I also think about some of the roads not taken. We've had some very compelling offers from large investors to take us out, to put big slugs of capital in. And we walked away from some middle of the process or even late in the process when we really needed the capital, to be honest. But as we looked around the corner and said, this is not going to be fun. This is someone who has either different values than we do, a different goal than we do, a different timeline, or they're going to be asking questions that we can't answer. And so, in our rare moments of reflection, we look back on some of those roads not taken, and we're super glad that we didn't go with someone just for the money. We were able to spend enough time with them to figure out that, even though we needed money and they had money to invest, there were several other things that were not aligned, and it was going to be a problem at some point.
That's a really good point. It's okay to say no.
Oh, it's so hard. It's so hard. Those are some of the hardest days in the company. Yeah.
Very cool.
Yeah.
Well, I kind of want to know, what's your next step? Like, what's the next step in terms of vision of your company? And what's the next step in terms of funds? What are you looking at in terms of markets?
Good.
Well, so we love what we're doing. We think we found a niche market that's underserved, that there are aspects of competition that are pretty tough, but there are also aspects of it where we've got a really nice lead, and we want to push that lead ahead. And so, we're in 4 states today. We'll be in 7 states in a few weeks. We have 5 states we're working on for 2023. The beauty of being in the U.S. health insurance business is it's a big country, and there's a lot of places for us to go. And virtually every market we look at, we see a competitive lane where a Friday could do very, very well. So we have a lot of runway ahead of us to just keep what we're doing and keep getting better at what we're doing. And then somewhere down the line, I think we're going to have a decision to make. There are lots of other health insurance markets in the United States, whether it's Medicare, whether it's Medicaid, whether it's employer groups. And we'll have an interesting decision to say, who needs Friday the most, and which of these different sort of verticals within the health insurance market would our model work the best in. So we're trying not to get distracted by that right now. We see opportunities in all those places, but we have so much opportunity in front of us just by doing what we're doing and continue to get better at it, that we're mostly just staying focused on opening more new states and more new cities in our current business model.
Yeah, and for us, we love what we're doing too. We all feel super blessed to invest this capital in impact companies here in our home state of Colorado. We don't have to travel like I used to all the time when I worked in private equity. We get to do it right here in our backyard and see these things grow. And we want this to be, like I said, an asset that lasts for a long time here in Colorado. So we have probably 3 or 4 more investments to make out of our second fund, and then we'll be out raising more money like venture funds do when they get all their capital invested. And it'll be from probably the same set of investors. We've thought about potentially trying to expand our model out of Colorado. That could take the form of partnering with somebody in another state, that is interested in this kind of model and helping them grow a similar impact model that's state focused. That's always been, kind of an aspiration, something we've thought about. So yeah, we just want to keep doing what we're doing and maybe then pass along some of the knowledge that we've learned to other places.
Do you tend to co-invest as well, or what does that look like?
Yeah. It's funny. I think very early on, my partner Jim and I come from kind of later stage private equity where you don't partner as much. And so our first few investments, we actually tended to be the only institutional investor in the round, but we quickly learned that was a bad idea. I mean, these syndication in these early stages and partnering with other really smart people is super, super important in early stage investing, I think. So we tend now more to try to find as many really smart co-investors as we can in these early days, because building and helping to scale these businesses is a lot of work, and it's way too much work for one institutional fund. It's usually better to have a lot of partners to help you out.
Dave, this is an off-topic question for you. Do you invest?
Do I invest?
Yes, and if you do, what do you invest in?
I am heavily invested in a Colorado-based health insurance company.
That's a good one.
And not well diversified at this point. So it's funny. I like watching what Ryan and others like him do and how they actually pick companies and invest in companies and nurture companies along. But no, I'm a little focused right now.
Absolutely. And as an entrepreneur, I mean, it's a full-time job, day in and day night.
Yeah.
Well, I mean, we have founders in this room, right? The whole point of Denver Startup Week is to learn from you guys. So one thing before we open up to questions, what advice do you have for entrepreneurs that are trying to grow and scaling and getting no's? And what advice, you have when people are thinking about raising capital? How should they structure themselves in a way to meet people like you?
A couple things that might not be obvious or weren't obvious to me necessarily when we got going. Good partners, good co-founders are more important than you could possibly think. If you're somewhere along this path and you've had a few dark days, and you probably have a few more coming. And there were days where I was ready to throw it in, but I had a co-founder next to me who was like, okay, get out of here, go take a bike ride, come back when you got your head straight, I got it. And then there were days where I had to throw him out of the office, say, all right, go hit golf balls. We don't need you here. We got it, and we'll keep things rolling and then come back. But having that co-founder in the business that we worked together for a long time, a lot of trust, very complementary skills, got us through some of the really hard times in the business. And I can't recommend that enough. Even to the point now where, it's kind of legendary in, entrepreneurial companies in the US, there's a sort of a lone wolf solo founder. I read those stories and I think there's no freaking way that's true. There might be one person who's the CEO who you look at and say, that's the person that really made this happen. But there was a co-founder or a business partner in there somewhere that they relied upon. So I would say, find a partner, find a couple of partners when you're getting your company off the ground sooner rather than later, because you're going to need them.
And how did you find your partner?
We'd worked together for years in a prior venture before this. He had a sales background and wound up running sales in that company. I had a product development background and was running product in that company. And so we were often sort of paired up in different situations and just had, a history of sort of working together. And we've been tossing this idea around in our past company and kind of debating it and arguing it and trying to talk each other out of it before we finally got to a position where it's like, we're going to have to freaking do this.
And did you court any founders that didn't work out in the?
No, not really. Our original seed investors are still invested in the business. It's still on our board. The vast majority of the early leaders we brought into the company are still on the leadership team. Like, they've made it from $1 to $400 million. And, we think we've created a structure where we're going to be able to keep that leadership team together and continue adding to it and augmenting over time. But we feel like we made a lot of really good decisions on team and partners and investors early on in the company. And so we're not looking at crazy changes to the structure or to the people in order to grow the business and be successful.
Sure. I mean, it seems like you're so successful, but tell me some of your obstacles that you faced.
It's been a lot. I mean, raising capital was harder and took more time and was just more complicated than we thought. Like I said, we never envisioned getting to a point where someone wanted to write us a check that we needed and we would say no. But we had several of those situations where we kind of looked around the corner and said, this is, we see where this is going and it's not the right partner. And those are some of the hardest days in the company. We had one particularly hard day, and it was election day 2016, where a president got elected in Washington and both houses of Congress flipped to a party that had said they were going to abolish the Affordable Care Act, which was the basis of our entire business. And we had actually multiple term sheets on the table that we needed. They got pulled that day. And I remember being on a plane the day after election day, flying to New York to meet with these investors and see if I could get them back in. And I was writing up this presentation. I was sitting in an aisle seat, and it was about what's going to happen to the U.S. healthcare system under this new Trump administration with Republican House and Senate. And I looked over my shoulder and I realized there were complete strangers standing in the aisle looking over my shoulder who were trying to make sense of the election. Were saying, so do you really know what's going to happen? And I'm like, I know what I want to happen. And I got to, there aren't that many different ways this can go. And this is really what it is. But it was a fascinating day where I'm talking to a flight attendant and a physician and a nurse and all these people who are flying out to New York from Denver who were trying to make sense of what had just happened as we were trying to make sense of it, figure out, are we still a viable idea with the new regime in Washington? And interestingly enough, like most of the things we thought were going to happen kind of happened the way we thought they would. There were very few real surprises along the way. What we understood was that, despite a lot of political rhetoric, that most of the country viewed the ACA as a very successful law, successful piece of legislation that was improving people's lives. And that even the Republican replacement plans were very, very similar in detail to the original ACA, which is actually why they didn't get passed. There was no real material difference. We understood that early, and we were able to sort of lean on that as we kind of survived the fear and uncertainty and doubt around the change of the administration. And by surviving that, of course, we gained a little bit of resilience and toughness too, that now we're in a situation where we have a little bit of a regulatory tailwind from the Biden administration, almost to the point where we're not even sure how to react when there's an administration that is helping the business.
Sure. So I think what I'm hearing from you in terms of one of the characteristics founders should have is to be able to pivot and have resilience, right? That's the one thing I want people to take away from you as well.
We didn't pivot that much. I think we're more stubborn than resilient. I had to look it up too. Somebody asked me, how are you so resilient? I'm like, don't resilient people like bounce back off an obstacle and change course? Like, we're doing the same thing we set out to do. It may have taken us longer to raise capital or to convince people that the Affordable Care Act was pretty durable. But we're probably more stubborn than resilient.
Stubborn is good too.
Yeah, when you're right. Yeah, in the right situation. Yeah, if you're stubbornly wrong, that's not good.
So Ryan, tell me, what advice do you have for our founders trying to raise capital?
Yeah, I mean, I think the first decision point, I think for every founder in my experience is, do I want to raise institutional capital or not? And to me, that takes a lot of different forms. It's, do I want to take on partners that have responsibilities to their limited partners, right? I mean, we're investing capital that's not ours. And so we have this incredible fiduciary duty to do well by them. And that responsibility puts a lot of pressure on people like David and his team to execute and to deliver really good results. And so do I want to take on these partners that are going to have these responsibilities that create a really high bar for what I need to achieve and return expectations, et cetera. So I think you have to really decide, do I want to go down this road? Because it's not necessarily an easy road, and you're going to lose some control over the outcome. There's so many great businesses out there, and a really good friend of mine has started a pretty interesting business in the healthcare industry, and he's decided not to take institutional capital. He's created a business that makes money. He's not, maybe growing at a scale that he probably could by taking on external capital. But by the way, he owns 80% of the business. And, if he continues to grow it at 25, 30%, you can create a lot of wealth without taking institutional capital. So I think you always have to, in these early days, really decide, which of these roads do I want to go down? Because it's a super, super important decision in from my perspective, and take the institutional capital one can be pretty high risk in many ways.
It's a great point. And it's interesting. We started the business thinking we couldn't do it without institutional capital. And then we had no choice. We had to do it without institutional capital. And we kind of figured out, and we got to a point, it's like, we could keep doing this. The business is, we know how to make money in this business now, and we could grow at a slower rate without taking on institutional capital. We actually have a choice, and which surprised us. But we did get to that point. And, the reason we landed on, we really do need institutional capital is because we're such a small company in an industry of giants. And we felt like we just needed to get bigger. We needed to diversify our risk across some more geographic markets. And that was more important than the control we could have kept. But it was definitely a decision for us, and one that we were surprised that we were in a position to make it.
And then the other thing I would say is, if you do go down the institutional capital route and you're lucky enough to get some interest in your business by multiple people, I think we don't get enough questions about how we're going to help them get to where they want to be. It tends to be kind of a one-way street in a lot of these conversations, and that's not how it should be. There should be as much diligence coming in on the other end about, how are you going to help me find talent? How are you going to help me scale my company? How are you going to help me find customers? Put the ball in the court of your partner, and really make sure that they're the right partner that can help you, because there's a lot of money out there right now. It's extraordinary how much capital exists. So finding that group that's going to be the right fit that can truly add value to you is super important.
Yeah, it's okay to have high expectations of your investors.
Absolutely.
They're going to have high expectations of you.
Well, thank you, guys. We now actually have the opportunity to take questions from the audience. But before, I want you guys to raise your hand, and then we have a mic that will come to you, and we'll take your questions, as well as there'll be an opportunity for everyone online to also ask. So put them in the chat.
Hi, guys. Thank you so much. My name is Dylan. I just wanted to ask David, what does it look like, because you're going up against these giants, when you've identified a target community or market? What does that vanguard look like, and how do you build trust in those communities so that they switch to your product? Is it a low price thing, or is there a different strategy involved?
Yeah, it's a great question. Right now, the state of the market is you have to be price competitive. So if we are 5 to 7% less expensive than the legacy health insurers, we're going to get attention, and we're going to grab market share very, very quickly in the market. But we also know that's evidence of a really immature market. I mean, Americans are really good at buying stuff, and we don't just go out and buy the cheapest thing, obviously, unless we just don't know any better. And when you think about your own experience, very few of us in this room have probably bought health insurance for ourselves and our families before. We've always taken whatever our employer offered, and if we were lucky, there was a choice between an HMO and a PPO or something like that. But we're inexperienced. We're not very sophisticated about this as a country, but we know we're good at it. And so, we suspect that Americans over time are going to get experienced at buying health insurance and aren't just going to buy the plan that's cheapest in the market. They're going to actually ask some hard questions like, is my family physician in this network? Is the drug that I'm taking actually on the formulary? Do they offer good free stuff like primary care visits? So even though we're doing a lot of things like that today, offer great service, right? We're doing a lot of those things today. We don't actually think we're getting enough credit in the market for it. We think people are really buying from us because we hit the right price point. We think that they're going to stay because they like the benefits, they like the service, they like the network. And over time, we think American consumers are going to be as sophisticated about health insurance as they are about everything else they buy, and know, here are the 2 or 3 things that are important to me. I could pay a few more bucks to get those if I have to.
Thank you. Thank you. Ryan, I'm just kind of curious, because you talked about relationship building and finding the right fit. And just from a personal standpoint, I'm wondering if there's any specific business models, personality types, actions, activities that just instantly put you off and make you just instantly decide this is not the person for me.
That's a good one.
Yeah, I mean, I think one thing that's really big for us is humility. It's people that recognize, both their weaknesses as leaders, their current weaknesses in their business model. And I think the other thing is it's the classic kind of, overpromise, underdeliver syndrome. And that typically is pretty easy to figure out even in the first meeting. If somebody is likely, kind of pumping up a lot of the metrics in their business to get you excited. But the humility thing for me is really the most important, because typically those are people who both know where they need help, so they can come to us and say, "This is where I need help. Please help me." And then it's very clear how we can help deliver that to them. But second, they're typically very easy to work with and hire great people that are probably smarter than them, that are solving a lot of their challenges. That's not always easy to kind of figure out in the first meeting, but to me, that's kind of number one characteristic. And so anybody that comes in and is I think arrogant and can't speak to kind of any issues with their business, that's a huge red flag.
Thank you. This message is this question is for Ryan. It's been a long week. I'm going to give a couple statistics. 22, arguably 25 to 1. Group that's starting the greatest amount of small businesses, Hispanics. I founded a group called Hispanics in Tech. During the pandemic, we went from 1.5 to 1 point of all VC. Latinas are getting less than half of 1% of all VC. I'm sorry, I'm passionate about this. What is it going to take for our largest minority, and I know Federico is involved, for us to change? Because we're the driving engine of the country right now.
Yeah, well, that's bananas. Look, we're working really hard, at least at the Impact Fund, to change this. I mean, half of our companies have people of color founders, which we're really proud of. We have one fabulous woman, Latina entrepreneur, Lorena, who runs Maria Empanada, that we've backed. Frankly, though, we can do a lot better. A lot of it is, I think, partnering with people like you, getting out more into the community to meet these entrepreneurs. I don't think not enough of them come to us, I think. But it's not, but I think we need to be much more active and be out, because we know that they're out there. We know that this isn't an issue of quality of entrepreneurs or business models. This is really just connecting in ways that we haven't been able to, necessarily historically. But look, love to spend time with you after this and talk more about what more we can do. But it's those are not good statistics.
Just a general call to action for everybody around. Yep. I'm mixed. But ironically, with my career in tech, I go back to my first generation grandfather that worked the fields that got me started on Pong. Where I'm going to is whoever in the room, if you care, go to those communities, engage, give them role models, especially my Hispanic community. I mean, but you're dead on with part of that answer.
Yep.
Hello, this question's for David. So you work in a very complicated space. I'm curious how you brought your product to market. What was the sales strategy? How did you go from idea to people seeing you on the exchange and navigating such a complicated system?
Yeah. Well, first of all, you got to know it's complicated, and then you got to embrace it. And so that was sort of the first mental step for us, was this is going to be a complicated business. It's going to require capital. It's going to require lots of attorneys, in order to be in this business. That's just the deal. And you got to get over it. Every once in a while, even talking with investors and say, wow, this is a really seriously regulated business. Yeah, that it is. And you need to be up for that. You can't be in board meetings complaining about how much regulatory oversight we have, because we knew this getting in. So that was step A. But then we were able to break it down into steps or projects. Our original business plan was we were just going to launch de novo in a state. And, we read the regs, like, okay, you can file a new insurance license. There's a process to do it. And there's a certain amount of capital you have to put up and a bunch of steps you have to go through. And we were just going to do that. And we were in the process of doing that when we found this potential acquisition target. And we thought, all right, well, that would certainly shorten some of these steps to being a licensed health insurance company in the market. And then what also, once we saw this incredible service culture in Alamosa, we're like, all right, that's a much better idea than we already had. It would have been foolish to put in a business plan that we're going to find a local failing health insurance company with a great service culture and buy that and turn it around. That would not have been credible to us or anybody else. But we were fortunate that we found a way to really accelerate it through an acquisition the way that we did. In terms of going to the actual go-to-market, one of the things that's great about the Affordable Care Act is it created this distribution channel that we leverage, and that is the state and federal exchanges. And even though they had lots of implementation problems and teething problems, turns out they're pretty good marketplaces. And if you're trying to find health insurance, I suggest you go and check them out. And you can put in, where you live, your age, and who's in your family. And then you can do more sophisticated things there. They're like, say, here are the doctors I go to. Here are the drugs that I use. Here's a chronic condition that I have. And these systems actually are smart enough to help you navigate to the plan that's a better fit for you. And so we rely, though, on those distribution channels. We also, one of the things we were really wrong about and learned fast on was we thought, like a lot of tech businesses, they're the brokers in the middle. We're like, they're just travel agents. Technology is going to blow these people away. Turns out not so much. Buying health insurance is not buying a plane ticket. It's still complicated. We're still all learning how to do it. And when there is, an adult who's been in the business, who knows their way around, i.e. a broker, and it's free, people use it. And so we treat brokers with a lot of respect. We've invested significantly in our broker support, broker training programs. We pay at the high end of the commission scale to brokers, which is a contrast to a lot of the big health insurers. A lot of the big health insurers aren't really sure they want to be in this business, and they're not paying very good commissions. And so it's pretty easy for us to delight brokers everywhere we go. It's just not that difficult to do. So that's a little bit more about our go-to-market strategy, but we've taken advantage of the marketplaces that were created under the ACA for the most part.
Great. And I'll get back to the live audience, but I want to make sure there are questions from online. We'll take a few right now.
Yes, we have a question for Dave. What challenges did you have and foresee in the future expanding your provider network in these underserved communities?
Yeah,
Tough one.
it's a great question. And it's something we deal with all the time. And, we view our markets as, there are two types of markets that we serve. So in the urban and suburban markets, there tends to be a lot of provider competition. And even as a small carrier, sometimes with no members coming into a market, we're able to set up a competitive bidding process and play the different hospitals off each other and get very competitive rates very early on in the business. And it's worked better than we had even thought. We're pretty delighted with our results in the urban and suburban areas. Rural areas, it's a different deal, particularly in the rural West. You go to any county, there's going to be one county hospital there, and they are a monopoly provider. And so it's not really a negotiation, right? It's hey, you tell us what the price is here, and we will get our actuaries and build a premium based on that price. Please don't charge us more than you charge Blue Cross or the other guys. And then once we have a little bit of experience with them, sometimes we can say, we're really easy to work with. Can we get a 5% discount off of that? And, use our good service experience and relationships to maybe do a little bit better. But honestly, in rural Colorado in particular, what we've learned is that a lot of the rural hospitals, through no fault of their own, are hanging on by a thread. And the last thing they need is me to come in and grind them for another 10%. It seems like an equity issue that healthcare is much more expensive in rural areas than it is in urban areas, and it is. But these are small hospitals without a lot of capital, serving very disparate populations there, and it's a very different reality out there. And so for us, it's two different approaches, two different types of markets. Urban, suburban markets, bare-knuckled competition. It's an active bid auction process. We run it every year, and we'll kick a hospital out of our network if the guy across the street will save us 5%. In the rural areas, it's not a negotiation. We're paying their price, and we're actually concerned about their viability. because we now have members in that rural county, and we really don't want them to have to drive over a mountain pass in the middle of the night to go to the hospital. We want them to be able to stay in their own county for healthcare.
And we're going to take 2 more questions.
Yeah.
Hello. Hello, is this on?
Yeah.
Oh, well, hi. We are a Latino startup. We connect companies with the Latino workforce. And I was wondering, a lot of the questions that we get, when it comes to fundraising, VCs ask, what happens if, a big company like this monster comes and overtakes your idea and does it better? What's the best answer for that? When you're starting out, you're a baby company.
Yeah. I'll tell you what, just a little bit of perspective on that. I mean, having been investing institutional capital for a long time now, that's one of the most overrated, I think, reasons to not make an investment that's probably out there. Dave's a great example where, you've got some massively entrenched players, frankly, that are kind of asleep at the wheel in the market that he's in. And so Dave has picked a particular category to go after that, where he has an advantage, and he's grabbing market share from the biggest companies in the world. It's oftentimes very easy for somebody to say, oh, well, Google will come do this, Facebook will come do that. That doesn't really happen all that often, and it typically happens too late. When the business has already had a chance to really prove out a marketplace. If you do really have a unique I think approach that you're taking in a specific segment of the market, oftentimes let's come and buy your business. So I actually kind of like sometimes for there to be an industry structure where you've got some big players who may be asleep at the wheel, where you can come in with a really unique approach. So I think it's demonstrating that what you're doing is different, and that you've got runway, some runway to really get to a scale that matters. Because oftentimes if it's not a $100 million, market or business, the big guys aren't going to really pay attention until you're that big.
Yeah. What I would add is, we got that question a lot, and it's really important in our business because unlike a lot of tech businesses or science-based businesses, our intellectual property is out there for people to copy. Our pricing is public. Our product designs are public. Our provider network is public. Everything we're doing is out there, and someone could copy it if they really wanted to. And so we've had to really think through our response to that of, if they want to shadow price us, they probably can. If they wanted to copy our provider network, it would actually be harder than it looks, and here's why. If they wanted to copy our product designs, here are some of the things they would run into. And what's interesting, what we come back to over and over again is, everybody who's called their health insurance company has had a lousy experience or several. The culture of service in health insurance has been lousy for generations now. And the most sustainable thing that we could do that they could never copy is deliver good service and have a great service culture in your business, which is why this strategy of working in rural America and building the service culture is so important to us. We think it's actually possibly our only sustainable competitive advantage, other than we're really focused on this narrow niche that the big carriers are overlooking. But it's important to hear the question and to really think about it and break it down and ask yourself what's actually sustainable here. To Ryan's point, just because someone can copy doesn't mean they will. And when they do, it's often too late and it's cheaper to buy your company.
I think a lot of the investors don't think enough about, in my opinion, other startups being created in the category you're in. That's way more dangerous. Like for me,
totally true.
If I invest in something, if Sequoia launches a platform or Graycroft launches a platform at the same time, that's way riskier for me than worrying about like a Google or a Facebook coming in to compete with my company.
And unfortunately, we're out of time, but I'm sure our lovely panelists will stay a little bit and answer questions from the audience as well. But I just want to thank you for your knowledge, your expertise in leading our industry today. So let's give a hand and thank you to everyone that's also viewing virtually as well.
And thank you, Virginia. Appreciate it.